In this presentation, we will discuss the concepts of a marginal tax rate and average tax rate. These are going to be important concepts when discussing with clients or understanding our own taxes. They're going to be very important for us to discuss how much tax is going to be owed in relation to their taxable income. It's also important for things like projections. If the client comes to us and asks us what might happen if this kind of change to my tax circumstances happens, then we're going to have to know some concepts of what these ideas of a marginal and average tax rates are. Whenever we do estimates into the future, if a client, for example, needs to make estimated tax payments or needs to make some kind of adjustment to the types of withholdings they have from their employer W-2, we need to generally have some concept of what the marginal and average tax rates are to make those kind of determinations as well. Now, it's more complex than you would think because we do not have a flat tax system. We don't have one tax rate, which would make it easy for us to do things like projections. If we were to say, oh, your income's going to change next year, we're going to have to know what that change is, which is already an estimate. Once we know what that estimated change is, then we could say if it was a flat tax, just simply multiply it times the flat rate, and we would be able to understand what the estimated tax would be in the future under those conditions. Cannot do that with a progressive tax system because it could result in a change in the rate. So what rate are we talking about? For example, when we have a progressive tax system, if we had someone that was earning something above $160,726 but not over the 204,100 and was single, then we would have multiple different tax rates we're talking about. Notice some of their income would be taxed at 10%, some of it would be taxed at 12%, some of it at 22%, some of it at 24%, and then finally some of it at the 32%. So then we have to think about when the client asks us, how much tax do I pay? What is my tax rate? How much tax am I paying? What percentage of my income am I paying to the government? We need to answer those questions, and we can't answer them basically giving them this table. We can't basically say, well, you're paying 10% of 0 to 9,712% of. We could do that, but most clients that'll just go, that's not going to be helpful. That's not typically going to be useful. So we're going to need some other concepts to communicate with the clients and often to think about things like projections, and that's going to be the average and marginal tax rates. Note too that because we're using a progressive tax system, many tax preparers are basically going to be dependent on the software to do the actual tax calculation. In other words, the tax preparer will put the information into the data input. The data input will then produce the tax sheets, the actual tax forms. We can verify that up to, most tax preparers will verify that up to the taxable income and typically let the computer then figure out the tax table to work out what the actual tax would be. And that's fine, that's great, but then you're going to have to, of course, be able to interpret that in some way and answer questions related to it that the client will then have on it, and you're going to want to simplify those questions and not, once again, go back to a table such as this, but give some simplified type of answers. Whenever we're talking about percentages in a simplified type of answer related to one, the first thing we would think of is probably an average. So how much tax do we pay? The client would say, how much tax do we pay? On this? Well, we could say, here's your average tax rate. This is it on average. They want more in depth than that. We can then go into the progressive tax system in more depth, but overall we can say, well, this is basically on average what you're paying. And an average is just what it sounds. We can calculate an average by taking the total tax. And remember, if we were to do this in software, we would know what the total tax is. Why? Because the software would have calculated it, right? So we'll have the total tax. We could divide that by the taxable income. And that's something that we can double check, of course, within the software and get to that taxable income. The software, many software will give us the average tax rate as well. We want to understand what the average tax rate is so that we can use it properly. So if we were to see an example of this, for example, if we had the total tax was $20,000, just to give a simple example of an average, and then the taxable income was $100,000, the average then being $20,000 over $100,000 or 20%. That would be the average tax. Now, an average tax means that we're not talking about the actual tax rate because we have a progressive tax system. Whatever the average is, typically we're going to have some of the income that was taxed at lower rates on the progressive tax system, some of the tax that was taxed at the higher rates on the progressive tax system, and the average between the two is whatever the average is. So client asks us, how much tax do I pay? What's the percentage of tax I pay? Oh, well, you're in a progressive tax system, so it's a bit complex because we have a progressive tax system, but the average tax that you're paying on taxable income, not necessarily gross income, taxable income, is going to be this, right? That's going to be our answer to that. Now, we cannot typically just use an average oftentimes if we're talking about projections. So we can use the average to communicate with a client and say, look, this is about what you're paying on taxable income on average. But if the guess is then to say the client comes in and says, hey, look, I expect to earn more money next year. I expect to earn more money next year. How much more tax will I pay? We can't necessarily simply use the average because the average is not going to be at the highest tax bracket. They're already at the highest tax bracket. So that means that if we're thinking about a change, an increase in tax to the next year, we're going to have to use another concept in order to think about what's going to happen there, and that will be a marginal tax rate. So a marginal tax rate, remember, if we're talking about someone that is basically up here in the 32% tax bracket, let's say their average tax was something below that, right? If they're up here and if they're single and they're making between $160,726 and $207,100, then the highest tax bracket they are paying is at the 32%. However, they're also paying some money at 10%, some at 12%, some at 22%, and so on and so forth. The average tax rate is going to be something below the 32%. So if they ask us how much on average do we pay, it's going to be something below the 32%. We can give them that average number. Again, software will typically provide that to us, as we'll see in future presentations. But we don't want to use that typically for the projection, because if they're going to make more money in the future, they're going to have to be paying that. They're already up here in the top tax bracket. So any added dollar is not going to be taxed at the average. It's going to be taxed at the highest rate, which is the marginal rate. So the marginal rate is really important because that's the last dollar. If someone's making a decision as to, should I work harder, should I do more at this point in time, given the fact of how much tax I'm having taken out, well, you have to consider the top tax rate. That's how much is going to be taken out of the next dollar that you make, not the average tax rate. So it's really important to know that for the projections. Now, of course, most of the time, if you're giving a projection, you typically, to do it right, you want to put that in the tax software and allow the tax software to do the proper projection and give you a more accurate calculation rather than just putting, well, what's the average and putting it into a calculator. But even if you do the average and put it into a calculator, or if you get the change in tax, what they think is going to happen in the future, and you're just talking with the client and saying, well, what might happen in terms of added taxes, you then got to remember, well, you need to be taking the marginal tax rate then, because that added money that they're going to be getting is going to be at their top tier tax bracket, not at the average tax bracket. So that's going to be important to be in consideration there.